Hi, this is Joe Gailey, and welcome to this educational webcast, the second installment on the subject, should I incorporate my business? In the last installment, we covered the topic of liability to the business owner. In this installment, we're going to cover the topic of taxation and what benefits or disadvantages incorporating a business could cause. Now, as a sole proprietor or an unincorporated business, you pay income taxes at what your normal income tax bracket would be, based upon your income, your spouse's income. And in most circumstances, that is going to be 12% to 22% in today's tax rates. If you incorporate, that tax rate is a minimum 21%. So on its face, it looks like it would not be a smart move to incorporate, at least from a tax viewpoint. However, everything isn't as it appears in tax law. When you're an unincorporated business owner, you also have to pay Social Security tax, which is called self-employment tax, on every dime you receive, or profit at least that you receive, which is 12.9%. If you incorporate and if you elect what's known as Subchapter S status, then you can avoid some of that self-employment tax, and you can have the business income taxed at the same rate as same individual rate that it would have been taxed at anyway. Now, this is the big benefit, or at least tax benefit, for almost everyone that incorporates that business, is this Social Security savings. The difference is this: all businesses have to make money and retain it to grow. Now, if you're an unincorporated person, you pay income tax and self-employment tax on whatever money you've retained. If you're a Subchapter S corporation, you pay income tax on it, but not self-employment tax. So you can save 12%. Now, 12% doesn't sound like a lot, but let's say that you've retained $10,000, $15,000 in your business this year for future growth. Well, 12% is a lot of money. That would be $1,200 to almost $2,000. And to a small business owner, that is a lot of money, particularly in the formative years when you're first getting started. So this is not a small thing. It can be particularly a great tax benefit. Now, as in all tax benefits, the IRS looks for Subchapter S corporations who don't take significant salaries. Now, if you take a salary, of course, you have to pay Social Security tax on that. And accordingly, if you're a Subchapter S corporation, the IRS will look to see if the salary you've taken is too small. And if it is, they'll adjust it and assess those Social Security taxes that you were trying to avoid. This is mostly an art as to how much you can take and how much you can't take. And you need an experienced accountant who knows tax law to give you an opinion about what should be free from audit and what's not free from audit. So if you go that route, you need to get an experienced CPA to advise you in these areas. And if you do, there'll be a lot of tax savings on down the road. As always, these issues have been presented on a simplified basis, and unfortunately, life is much more complicated. Your circumstances may be such that this advice is not well suited for you. So, do not rely upon my advice. Instead, seek advice from a competent professional. And I hope that you've learned enough from this to at least know what questions to ask and what to look out for. If you have any additional questions, please contact me at the email address you see on your screen, and I will try to respond as my schedule allows. Thank you for tuning in and have a great day.